If gold even went well above 8,000 to get to another eightfold move, it would only be matching the same dimensions it's done twice before in the last 50 years. The difference this time in our assessment is the technicals and fundamentals are far different, far more bullish for gold and for monetary metals than they ever were. Hence, going back to 8,000 would be just a yawn. Oh, we've done it twice before. Big deal. Don't even expect 8,000 to stop it. But we're just pointing that out because people think, gosh, if you look at an arithmetic chart of gold, a normal everyday chart, you think, oh my gosh, it's left the page. No, it hasn't. It's only half the dimension of the prior two bull markets. If you took the prior move in silver on a ratio scale and added it to the point of, we could be $500. Just the dimension of the range to the top. Well, a tenfold move getting above 50 means you could go to 500 just to match the dimension of the ratio moves that have persisted for 50 years.
Veteran technical analyst Michael Oliver argues that a gold move above 8,000 would not be extreme by historical standards. When viewed on a long-term ratio or logarithmic chart, gold's prior bull markets delivered similar eightfold advances, twice in the past 50 years. Oliver emphasizes that today's technical and fundamental backdrop is far more bullish, driven by monetary instability and weakening confidence in fiat systems. On an arithmetic chart, gold may appear overextended, but structurally, it is only halfway through its historical range. Applying similar ratio analysis to silver suggests potential upside toward $500, reinforcing the long-term bullish case for monetary metals. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
This page shows charts that measure the monetary metals, gold, silver versus the stock market, gold versus the stock market, and even the gold and silver miners. But the top chart here shows, going back to 2013, each month we take the close of gold and divide it into the S&P price and express it as a percent, and we plot it. Okay, so these are monthly closes going back, to 2013. It's when gold was really collapsing back then. Also in relative performance, it was coming down. But since about 2015, you see the price action, the spread action has basically been either side of 50%, been above it and below it, above it and below it, but sort of really going sort of sideways. So gold's been hanging in there versus the S&P, been doing as well. November's close broke out above that 4-point, very gradual downtrend line that capped off this relative performance chart for 11 years. It broke it out in November. Well, of course, in December, gold had a good up month, while the S&P had a slight down month, I think. The spread went even further in December. But that chart has just now broken through a huge wide base. This is the start of something, not the end of a bull market. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. What it's telling you is money is starting to shift from the stock market to the gold market. It's actually been going on since 2024 when you were near the bottom of there. But now it's broken out. So this is effectively a fresh buy signal telling you, if you're an investor, should you be in gold or the stock market? It says, yeah, you should be in gold. It's just begun. Okay, scroll down to that next chart right below there, silver versus S&P. Also in November, it broke out over a similar basing pattern and relative performance to the stock market. That arrow shows where it was in November. Look at the December close. Whoosh, even further. So silver has also said, I'm out of here, freshly so, versus the U.S. stock market. This is not a late signal. This is an early signal. And then scroll down one more. Surprise most people here. This is the gold and silver miners via the XAU index, which includes gold and silver. It's done the same thing. It broke out in November, gained more in December, of a base of performance that's defined by 1, 2, 3, 4 peaks hit that red line before you broke out. So each of these charts are telling us that the monetary metals and their miners have only just shifted trend versus the U.S. stock market. It's a fresh buy signal telling you, if you're going to reallocate now, you're not late in terms of the asset class shift. So these signals should not be occurring if, in fact, as the skeptics think, we're at a top in the monetary metal. This should not be occurring. These guys should have broken out years ago and been at some peak a couple years later. Then maybe we could talk about a top. This just began. So This is a smack in the face indicator that tells you, no, don't believe in the skeptics. Anyway, these are important. Go to the next page again, and we'll look at that other chart, which shows, okay, let's say you're in the monetary metals, whether you own bullion or mining stocks or ETFs on silver or gold, whatever. Where do you emphasize your long position within the monetary metal? Yes, over recent years, gold has been a better place, but that just changed. So not only did silver and gold break out versus the S&P, but silver has broken out of a decade-wide basing range versus gold. It's saying, I'm coming out of here. I'm going to beat you, gold.
Recent relative performance charts reveal a major trend shift favoring monetary metals over U.S. stocks. Monthly data comparing gold, silver, and mining shares to the S&P 500 show decisive breakouts in November and follow-through strength in December. After more than a decade of sideways basing, gold versus the stock market has broken a long-term downtrend, signaling fresh capital rotation. Silver has delivered an even stronger breakout, both against the S&P 500 and versus gold itself, ending a decade-long reign. Mining stocks, measured by the XAU index, confirm the move. These synchronized breakouts represent early-stage buy signals, not late-cycle exhaustion, indicating a newly emerging bull phase for monetary metals. Let's get back to the interview.
Silver had already been in a bull trend, so had gold. But at that point, silver suddenly broke out versus gold. And in the next 7 months, so about 2 quarters, it doubled and a half in price. Okay, this just broke out. So we set our clocks here and say, listen, we've learned in the past, and there's other examples of this, where when you do this kind of breakout, give it a couple quarters and you should see a gush in net price. Now, maybe it goes further, but the gush part, the extreme change, occurs literally in the next couple quarters after the spread breaks out. The spread just broke out. Don't expect a top or any sort of topping action or even a corrective action of significance until we get into the second quarter. And this spread isn't going to be where it is. Now scroll down, you'll see some examples of where silver has been. Right now it's at 1.6% of the ounce of gold. What we do here is we divide silver ounce into an ounce of gold, express it as a percent. This shows 50 years. What was the peak spread reading on a percentage basis of silver price versus gold going back to 1975? Well, you get that red horizontal line is at 2%. And you can see that in 20 years, in the past 50 years, silver's at least been 2% or higher. Well, right now it's 1.6. And we just broke out over the last 10 years of highs, that little green line, which we showed closer up on the chart above. You just broke out. If you even just go to 2%, I mean, that's a huge move from 1.6 to 2. On a ratio basis of silver versus gold. But we're in a bull market. And when you go back and look at the bull markets in net price of silver and where the spread was then, look at that 79 peak when it was gushing to the upside to the early 1980 high in price. The spread was at 6.5%. And then go to the 2011 high, when again, silver rushed up to 50 within the old price range. The spread was over 3%. Well, right now at 1.6, just to get to the spread level that we saw in 2011, you got to like double silver's performance level that it currently exists at. And since we're in a bull market, I would tend to think that one, that 2% level is not going to be resistance. Instead, it's going to go up and challenge, perhaps even take out the performance highs it saw at the 2 prior bull markets, the one at over 3% and the one over 6%. Don't be shocked. But that just shows how cheap silver still is, despite the recent breakout on that chart above. We took out 10 years worth of highs. You're still cheap. And I think silver's new reality in price is also going to be reflected by a new reality in its relative performance. So again, we have fresh signals here that say, hey, it's only begun. Quit talking about a top.
Silver's recent breakout versus gold marks the early stages of a powerful bull phase acceleration. Historically, when the silver to gold ratio breaks out of long basing patterns, explosive upside follows within 2 to 3 quarters. The ratio has just cleared a decade-long ceiling at roughly 1.6%, signaling a major regime shift. Over the past 50 years, silver has frequently traded above 2% of gold, with prior bull markets reaching 3% in 2011 and an extreme 6.5% in 1980. Even a return to 2% implies significant upside, highlighting how undervalued silver remains. These conditions point to a developing surge, not a market top. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.